Good day. Thank you for joining me for the latest edition of the Citadel Update series. I'm Mike van der Westhuizen, a portfolio manager within the Citadel Asset Management team. On behalf of your extended Citadel family, I hope that you and your families are well through these testing times. And it's not only a time for physical resilience, it's also a time for mental resilience in whatever situation you find yourself in. Today, I'll be sharing some of the latest economic updates, as well as talk to you about fixed income markets and some of our fixed income solutions. So if you'll bear with me for a few seconds, I'm just going to share my screen. So our chief economist, Martin Ackerman, gave a very good overview of the House's economic views a couple of weeks ago, so you can catch up on those there. But I'm going to go through some of the latest data here. Firstly, a brief COVID-19 overview. I know there's a lot of data and news out there and discussions that I'm sure a lot of you are sick of hearing. But important points to note on these slides over here is that, this is just a 10-day rolling change in the number of cases. So sort of case growth over 10-day periods for a while now has sort of plateaued. If you look at it as a percentage increase in number of cases, that's slowly started to come down, but cases are still increasing at a rate of about 20% globally every 10 days. So the global number now is sitting at about 4 million cases. There have been some instances in places like China, Germany, and South Korea where there has been a pickup in number of cases and fear of a second wave there. And Dr. Fauci in the US yesterday coming out to say that the US situation is not fully under control. While some states are seeing peak in number of cases, others are failing to contain those. And if you strip out the New York numbers, which are by and large the large portion of the numbers in the US, case growth is still increasing. In terms of lockdown globally, certain countries are trying to open up their economies again. This talks about the stringency of different lockdown regimes. You can see South Africa at the bottom there. If you look at the scale over here, is one of the most stringent. But you can see there are a lot of other countries with this stringent lockdown, and sort of US, China, India, and Australia are among some of the least stringent measures globally at this stage. So some important economic data that came out of the US last week, employment number. This chart is actually the March chart. I'm going to now flip over to the April chart just to show you what a massive number that is. And you can see that all of these bars throughout the last 15 or 10, 12 years are dwarfed by this latest number. So 20.5 million jobs lost in April. Unemployment rate rising to 14.7%. If I just show you another way of looking at this, this is an increase in unemployment from a low. So you can see how this 2020 employment recession here is massive, and the 2007 recession pales in comparison to that. What's important to note here is that it does take a while for employment to pick up again. So even if economies start to open up, there is bound to be some slack in the market, and it'll take a while to get back to those lows that we saw earlier this year. One of the saving graces for those unemployed that have lost some of their income is that fiscal packages by the US government have somewhat plugged that gap in income. So if you look at the black line here, this talks to disposable personal income. And consumers in the US are expected to, sort of have income and be compensated by the government for at least the next 2 quarters. There are talks of further fiscal stimulus packages to aid the man on the street, but we'll wait to see what comes out of that. Then yesterday, also another shocker of a big number. We had the biggest month-on-month decline in core CPI in the US, core inflation. That's your inflation basket ex food and oil. That fell 0.45% on the month-on-month basis, taking core CPI on a year-on-year basis to 1.4%, headline at 0.3% year-on-year. Inflation is expected to be somewhat muted for over the short term, but with some of the big packages and big stimulus packages that have come out of the government, inflation will pick up eventually over time. But for now, disinflationary forces are still very much at the fore. A lot of nice data in terms of real-time data, what they call nowcasting, looking at high-frequency data releases. On the left-hand side, I've got the US. The right-hand side, I've got China. This just speaks to the 0% line is the what is considered normal levels of activity. So anything below that means that activity has slowed quite a bit, and above it means that activity in these sectors has picked up. You can see that the US still very much below normal levels of activity, especially in some of the consumption areas. I mean, obviously, there's no flying air bookings, hotels still way below. And it's interesting in China because China has somewhat will open their economy somewhat. You've seen a return to normality in property sales and auto sales to some extent, but you can see that consumer spending sectors are still very much below normal, aside from online. So what this tells us is even when economies go back to work and start opening up again, there is going to be a marked change in behavior, and in terms of these economies returning back to full capacity, as a lot of people expect, in terms of what they call a V-shaped recovery, is probably a dream at this point in time. Then on to South Africa, the PMI manufacturing index. If you look at some of the underlying components, business activity, which makes up 25% of the measurement, that indicates the actual drop in manufacturing activity came at a very, very low number of 5.5, and the scale here is from 0 to 100. New sales orders, which indicate the demand picture in the economy, also falling to about 8.9 on a scale of 0 to 100, and then employment also looking weak. So you can just see the massive drop off here. Employment is a precursor for the tough times that we face in this country, given the extended lockdown. And then an indicator that points to or is a bellwether for the consumer and consumption within South Africa: vehicle sales falling on a year-on-year basis by 98.4% in the latest print. So that doesn't bode well for the consumption picture. Then just to pull everything together, this is IMF forecast for growth. World growth expected to fall just under 4%, the US at around 6% decline. The important thing here is to consider, rather than the actual magnitude of the numbers, the different downside scenarios given extended lockdowns or second waves of outbreak. So if there's a longer outbreak than expected, world growth is expected to fall by an additional 3% on top of the 3%. And in a very worst case scenario where we have a longer outbreak in 2020 and then a new outbreak or a second wave in 2021, it shaves off another 8% of economic growth. So just speaks to a very, very tough environment. We did expect that in the second quarter, given the shutdown of many economies, that numbers would be bad, and we are in the midst of that storm now. So continue to track that data as it comes out, but still expecting more of a U-shaped recovery than just a straight up V-shaped recovery. So while the market and economic data is abysmal, the liquidity conditions, so this is support coming from Federal Reserve in the US and central banks around the world, as well as the massive fiscal spend, and liquidity conditions or monetary conditions are the easiest that they've been in many decades. So this goes back into the 70s. And this wall of liquidity, or this wave of liquidity, is what has been supporting risk markets. So it gets to this very, it's a massive discussion point at this stage called the dangerous gap between Wall Street and Main Street. So Wall Street being your big companies being bailed out by the Federal Reserve and by the government, and Main Street, where we're seeing massive job losses and struggling population. Is a continued widening in this inequality gap. So just on the right hand side, the top 1% of the rich continue to get richer, and the poor continue to get poorer. And this round of stimulus and central bank action will only exacerbate this phenomenon. So quickly on to a fixed income market update. There's a lot to cover in fixed income markets, but I'm going to try and keep it simple. And first of all, I think it's maybe prudent to just give a quick fixed income and bond refresher. I know some of you might understand bonds fully, but even some of my colleagues' eyes glaze over when I start talking about bonds. So a bond is essentially you're making a loan to either a government or a company in exchange for interest payments and your capital at the end of whatever the term of the loan is. The factors affecting bonds are growth and inflation, monetary and fiscal policy, risk sentiment, and then obviously specific company-specific and country-specific risks. And then one of the most important diagrams in understanding how bonds are priced is the bond price, bond interest rate seesaw. And so when we talk about interest rates rising, it means that bond prices are falling. And when we talk about interest rates falling, it means bond prices are rising. Okay, so we'll try and explain as we go along and keep it clear, but just in case I slip up there. So if we just summarize some of these factors that I've spoken about, growth. So we expect low single-digit growth over the next 3 years in the US, close to 0% growth in SA over the next 3 years. Low growth is typically supportive of bond prices. Low inflation is also supportive of bond prices, and relative to history, we were experiencing low inflation for the time being in the US and in SA. Monetary policy is also, so easy monetary policy is also supportive of bond prices. We have extremely loose monetary policy in the US and increasingly loose monetary policy in South Africa as the Reserve Bank has continued to cut interest rates with more cuts expected. Fiscal policy, that is actually bad for bonds in a case where there's additional funding required and more bonds need to be issued, which increases the supply of bonds. And then just in terms of behavior in a risk-off environment, I've used as an example here, but US Treasuries are seen as a safe haven asset and are bought when in a risk-off environment. South African government bonds are seen as a riskier part of the fixed income market, along with emerging markets and corporate bonds, and they're actually sold in a risk-off environment. So US Treasuries act very nicely as a diversifying asset in a multi-asset portfolio, especially for a South African investor, because in a risk-off environment, you see Treasury prices rising and you see the rand depreciating, which adds to your return in that instance. If we just look at what's happened in fixed income markets year to date, this is to the end of April. We've seen a surge in Treasury prices. This is prices now, so the actual return, close to 9% return from Treasuries, around 3.5% from mortgage-backed securities, which are government guaranteed almost. Investment-grade corporate bonds have given you about 1.42% in dollars. Emerging market dollar bonds have given you a minus 10% return. US high-yield corporate bonds have given you a minus 10% return, and emerging market local currency debt, and this is measured in dollars, has given you a minus 12% return. And in this basket is South African government bonds. So I spoke about monetary policy and fiscal policy earlier. I just want to highlight a couple of things here. So quantitative easing or asset purchases of US Treasuries under the QE4 program. These QE1, QE2, QE3 were during or following the global financial crisis. QE4 in scale has been absolutely massive, and it's been a lot quicker in terms of support and buying of bonds by the central bank than all other programs combined. And if you just look at this is the daily purchases of treasuries. At one point, the Federal Reserve was buying $75 billion of US treasuries per day in the open market. They've started to taper this as the market has started to function a bit better and are now purchasing around $10 billion worth of treasuries per day. On the other side of the picture, so as I mentioned earlier, the treasury purchases is supportive of prices. On the other side, the increase in debt is not supportive of prices over the medium term. So we can see debt, this is a global debt picture, debt has risen significantly. And, you know, this President Trump, I put this joke here, I flatten the debt curve, and Mr. President, you're holding it sideways. But the point is that under President Trump's 4 years in office, he's almost accumulated as much debt as President Obama in 2 terms in office. And that's largely due to his fiscal spend. This quarter alone, the US Treasury expected to issue about $3 trillion worth of new debt. So that's expected to put some pressure on prices going forward. Then just to look at US Treasury yields. Okay, so remember, if yields are going down, it means prices are going up. I've put here the US 10-year Treasury yield and the US 3-month Treasury yield. And during this period last year, I'm sure if you listen to some of our other client presentations, we noticed that the 3-month yields actually were higher than the 10-year yields, which points to a yield curve inversion, which is a precursor for, or as a good recession indicator historically. And I mean, whether you like to believe it or not, it was right at the time, as we sit in the midst of a recession at this stage. But the point is here, given the market turmoil and the liquidity crunch in March, US Treasury yields rallied significantly from a 1.5% yield to close to a low of 30 basis points or 0.3%. So prices rose dramatically at that stage. And yields are currently sitting at about 0.7%. And if we just look at the push-pull factors in terms of yield, so low growth, low inflation is supportive of yields. Purchase by the Fed puts somewhat of a cap on yields rising too much. And in a risk-off environment, should we see one again, it acts as a good insurance policy and a good diversifying asset. On the other side, as I mentioned, the widening fiscal deficit and funding needs, put upward pressure on yields over time. And the real yield, so if you take the actual yield less inflation expectations, it's not a great indication from this point in terms of good future return prospects. Can this yield go negative? Yes, it can. The Fed Chair Powell has said they are not wanting yields to go negative because they've seen the negative effects of that globally. But after what we've seen recently with negative oil prices, etc., you can't discount that not happening. Then in terms of credit spreads, so the credit spreads are the compensation that you get over and above investing in US Treasuries. This is US investment grade. Also, during the market turmoil in March, these sold off aggressively, which means credit prices fell, yield spreads rose to about 350 basis points over and above Treasuries. And with some of the stimulus packages and support for the credit markets, spreads have fallen and declined quite a bit. We still find credit in the investment grade space attractive relative to history. And so we have added some investment grade credit where warranted and where the mandate allows. Then on to South African bonds. That's been another asset class that we've become more constructive on over the last quarter. So we're looking here at relative real rates. So that's if you take the yield on the bond minus the inflation in the country. The higher the real yield, the more attractive the bond is. And this is graded by different credit rating. And you'll remember that we as a sovereign got downgraded by Moody's to sub-investment grade in the first quarter, and S&P also came out and downgraded us further into the sub-investment grade space. But still, relative to peers in the sub-investment grade space, South African yields still appear attractive. On the other side of the coin, the debt dynamics don't look all that favorable. So in terms of a budget deficit expectations for this year, and that's where expenditure exceeds revenue collected through tax. That's expected to be about 12% of GDP, and that's obviously exacerbated by the government shutdown. 285 billion rand shortfall expected in tax by SARS this year. And this graph on the right is the debt to GDP ratio, which during the 2019 budget, Treasury expected that to rise to about 60% at the end of 2022-23 fiscal year. At the 2020 budget in Feb, that they revised their forecast to 71% of GDP. The national the National Treasury at 70%. The rating agencies, Moody and S&P, haven't been as positive as what National Treasury has said, and they're calling for ratios of close to 91 and 84.7%. So that's an issue. In order to fund this deficit, government needs to issue bonds, and we just, at the moment, on a weekly basis, Treasury is issuing about 6.1 billion rand of government debt. And just to contextualize us, because unfortunately, as much as we like to see our South African idiosyncratic problems. To global investors, we are just another emerging market. And on that basis, even in this top right block here, we remain somewhat fragile from a fiscal position and from an external position, not due to external debt, because we have a very low external debt holding, but mainly due to current, foreigners funding our current account deficit, and also so that's not looking, doesn't look as positive as some other emerging markets. Flows during March, we had massive outflows, and this is not a South African story alone. There were plenty of flows out of other emerging markets, and since then, outflows have stemmed around the end of the World Government Bond Index exclusion on the 30th of April. A lot of market participants expected a large outflow of debt from our market, of debt from our market, or foreigners selling debt out of our market, and that didn't really happen. It just sort of slipped by. And we'll look at that in terms of price. So this is the price of the 10-year South African government bond. So if it's going up, it means that price is appreciating and you're earning a positive return. So at its worst, following the global liquidity crunch, bonds fell close to 18%, and that's in terms of capital loss. We had stimulus from some global and SA and from the South African Reserve Bank intervening in the market as well. And then we had the World Government Bond Index on the 20th. So we've had a very, very strong rally in bonds, especially since the end of April, to a point where bonds for the last year are almost flat. If I just take you to the yield basis, because this gives you a nice picture as well, yields rising means prices falling. So we had yields rising from about 9% to close to 12.5%. I mean, this is a daily chart. Intraday, we got to a point where yields actually spiked to over 13%. And with the stimulus, yields have pulled back all the way to about 9.5, 9.3. So, what are the positive factors for bonds? Low inflation and high real yields that I mentioned. It's attractive on a relative basis versus its peer group in the bond space, and as well as versus other South African asset classes. The loose global liquidity conditions and the hunt for yield will be supportive of SA bonds for now. And for now, also positive global risk sentiment will be supportive. As I mentioned, some of the negatives are, and by and large, is the widening fiscal deficit and funding needs. Low growth, I mentioned earlier, is good for bonds generally, but in a low growth scenario where it affects revenue and also affects us debt to GDP ratio, it's not positive. We're seeing a lack of structural reform that we're hoping will be improved post the COVID-19 spell, as government says. And then we're still waiting on the revised budget from Minister Mboweni. So we had a fiscal package announced of 500 billion rand, was expected to be somewhat deficit and budget neutral, but we need to see what the minister has to say in order to gain more insight. So from a total SA bond perspective, yields remain attractive from an income perspective. From a capital return perspective, we were very, very positive on bonds at above 11% yield, but due to this rally, a large part of the capital appreciation has been realized. So we don't expect a lot more capital appreciation, but as I said, from an income perspective, yields are still attractive at this stage. Then quickly onto some of our solutions. In the local space, South African space, we have the Citadel SA Money Market Fund, the Citadel SA Income H4 Fund, which we like to call our Enhanced Money Market Fund, giving you about 30 to 50 basis points over and above traditional money market funds after fees. And then our Citadel SA Bond H4 Fund. And then the global, mostly the US space, the Peregrine Enhanced US Dollar Cash Fund and the Peregrine US Bond Fund. Both of these are relatively new, with inception dates in July in terms of enhanced cash and September in terms of US bond of last year. So risk, especially in these low risk products, is very much front of mind. Now I'd just like to show you a risk reward scatter plot of the Citadel SA Income Fund versus the peer group. So this little triangle here is the peer group. The little red shape over here is the benchmark, the STEFI composite index, and the orangey dot here is the Citadel SA income fund. And on the x-axis is a standard deviation, a measure of risk, and up on the y-axis is return. So what I'm trying to point out here is that this fund remains one of the lowest risk, highest reward on that plane amongst all of its peers. Okay, there's one or two guys here that have done well, but this fund is still up there. Then in terms of credit quality, because we get a lot of questions on this, the credit assets, the assets in both of these money market and income fund are high quality investment grade assets. We don't try and look into the high yield space to try and gain additional yield in any of these products. And then just our Citadel SA bond fund, also a risk return scatter plot, and this is over 3 years as well. And Citadel SA bond fund sitting well left of the benchmark in terms of risk and well ahead of the benchmark in terms of return. And the peer group sits down here. So just to reiterate, a focus on risk management at all times. I'm not trying to be too clever or too fancy to shoot the lights out, but when the market does sell off, this fund tends to sell off less. So limiting drawdowns means that over time the fund outperforms nicely. And that's all I have for you today. Thank you very much for your time. I'm happy to take any questions that you might want to send through your wealth manager. Thank you very much.